you spend more than half of your time working on those rentals out of all the time you spend on all your trades and businesses, and you spend more than 750 hours or services in those real estates. Does that make sense? So it's very important, those two conditions. That's why will allow you to treat your rental property as a business, not as a passive income. Other than that, it is by default treated as a passive income. And let me pause here and say something as well. I have a rental property, and until I decide otherwise, I will leave it as a default passive income. And here's what is in an L.L.C. So that means if we are going to be managing it ourselves, my husband will be highly involved, and I'll be more involved with the management, the administrative side, and he'll be more involved with, and we have a rental, an investment property that we are going to remodel and rent it out, and he's involved. We are both involved in it. But here is what, as an L.L.C, if you treat your rental properties as a business or as an activity, and you have a profit. Let's talk about the good side first. You have a loss, you'll be able to deduct that loss, apply that loss against your wages from your employer, your annual income from your jobs. That's the good side. The bad side is if you have a profit, all of your profits will be taxed by the Social Security and Medicaid. You'll apply that on it because you have to apply your Social Security rates and Medicaid rates on all your income for your business if you are using L.L.C. And then you cannot consider yourself as an employee. Any money you take out of your L.L.C is a draw. So you cannot deduct how much you take out of your L.L.C. You can deduct how much you pay your employees, but you cannot deduct how much you pay your partners and yourself that are managing the business. So you will apply Social Security on all your profits. And that's the sad part of it. So if you leave it as a rental, as a passive income, the Social Security is not applied on a passive income. It's only applied on an active income. So that's why, because my rentals are in an L.L.C, that's why I prefer to leave them as a passive income, even if we are actively involved. We just prefer to go with the first default of IRS. Doesn't matter how much you are involved with your rental, is a passive activity. It's nothing illegal. So I prefer to just stay with the default because it benefits me more leaving it there. And at the beginning, yes, the loss, we won't be able to deduct them against our incomes. It's not my point. It's not my goal to lower my taxable income by applying my rental loss to it. I'm just wanted to create a business and be successful. So, but by putting it here, by putting it under an active activity, I will be in the long run, I'll be paying Social Security on those incomes, and I don't want to do that. That's why my activity, my trade, my L.L.C, one of my L.L.C, I request IRS, I ask IRS to be taxed as an S Corp. And as an S Corp, I'll be an employee, and I will pay Social Security and Medicare on my income from that S Corp, LLC tax as an S Corp, and I will on my dividend, my profits taken out as a dividend, as distribution, I will pay tax at my current tax rate on that, but not Social Security tax on it. So if you have a rental property, that's why they mentioned that C Corp here. If you have a rental property and you LLC, you can file that form 8832 to be taxed as a C Corp. If you do that and you are managing your business actively, yes, you can move it from passive activity to the active activity if you met those two conditions below that we talk about. Most of your time is spent on managing those properties, viewing the rental applications, selecting the applicant, the right applicant for your property, introducing them to it, and when one move out, you clean up the place yourself, or you hire somebody to clean up, you supervise it. You pretty much manage your properties, and you manage the administrative side of it as well, and spend more than 750 hours a year to work on it, which is doable. If you work 4 hours on your business every day, for example, or 3 hours, I think it's doable. It's not a lot of hours in a year. You can call your rental property an active business, a trade or a business, a real property trade or a business, and apply the laws against your job's income. If you request from IRS by filling out Form 8832 to turn your LLC tax as a C Corp, that way, when you make profit, your profits, you are not going to pay Social Security on it. You'll pay Social Security on your salaries, but then your profit that you distribute, you'll pay just, capital gain, whatever the distribution. I think you'll fall under capital gain or dividend distribution or something like that. Will be the dividend. So you'll pay your tax or rates on those dividends. But the downside of the C Corp is the C Corp will be taxed a low tax rate. And then if you take any distribution out, you will pay your own tax rates on those distributions as well. That's the downside of that. And I'm not sure you can put a real estate under an S Corp. I'm not sure. I had to look into that. But that's what I'm using S Corp for my businesses, not for my real estate. Because as an S Corp, you don't pay tax. The business doesn't pay tax. It's all rolled back to your tax returns. So let's move down. That's pretty much what I wanted to share with you. The difference between passive and active incomes. And let's see what they say here more about it. Maybe, and once again, I will put this on my website so that you can download it and see those areas that we highlighted. So trade or business activities. Did we read this side? Let's go down. So a trade or business activity is an activity other than a rental activity or an activity treated as incidental to an activity of holding property for investment that involves the conduct of a trade or business within the meaning of Section 162 is conducted in anticipation of starting a trade or business or involves research or experimental expenditures deductible under Section 174. So a trade or a business activity, they're just trying to explain what it is everything but rental property. But you have this exception where you can turn your rental property into a trade or a business as well, that we discussed earlier above. And the incidental one is when you are renting your property for some part of the year, but it's not what you do originally, so something like that. So pretty much anything but that. And then they talk about so you are conducting a trade or a business, and they have this section that if you go read, you can just Google it. IRS, no, you don't say IRS, you will say IRC section 162, and that on Google search, and you should be able to pull it out and read it. What a conduct of a trade or business is. Maybe I might do a video on that if I found it important to do that. And then if you are doing a research to see if that's a good business to get into, yeah, even though you have not started the business, you'll be able to deduct those expenses if you're able to start the business that year or something like that. So that's something to read. And I believe they have 160, section 164 that cover that section as well. Where is that? That's here. To see what is deductible expenses, or if you can capitalize it. But a lot of time when you are doing research and you have not started the business that year, you won't be able to deduct the expense. But if you're able to start that business that year, you'll be able to deduct your research expenses or capitalize it, depending on what it is. And if the partner doesn't materially participate in the activity, a trade or a business activity conducted through a partnership is generally a passive activity for that partner. So when you fill up your partnership, if that's a trade or a business, you will fill up page 1 with those information. But for that partner, it's a passive activity. So let's go check our. So if you are filling up your 1065 for a business, for a native activity or a trade, so you'll fill up this page 1 with your gross sales, your everything, cost of the good and all that. Your income will go under this section, your expenses will go under these sections, and those things will be moved. You'll fill up this section for the deductions, and those information you'll see here: ordinary business income or loss. That line 22, you'll move it to your schedule K. Ordinary business income or loss, page 1, line 22. So you put it here. And then if you are in a rental property, you won't fill out page 1, but you fill up form 8825, and your income information will be here for that as well. So, and that's how, and then you just fill up your schedule K. And if you fill up page 1, the only thing you will fill up on schedule K will be line 1. That's pretty much it. If you have interest, like you put money in the bank account, it generates interest. I don't think you have, let me see if page 1 for that business particularly. Let's see if you have a section here for it. You don't have a section for it here. The section you have here is just for the what is directly related to that activity that you are working on, the revenue from it, your sales minus your returns, and all expenses related to those sales. And if you have cost of the goods sold, there is an attachment 1125 that you need to attach to it. And if you are depreciating things, you'll fill up those things as well. If that's the first time, you'll pull the depreciation sheet here, and you'll fill up those funds, and only the bottom total, line 22, will flow to your schedule K1. But if you put money at the bank and it generate in the saving account and it generate it generated some interest for you, then you will fill up this interest section here. But if you just have one activity and you were able to put it on page 1, you fill up this page, this row 1 for schedule K, and that's pretty much it. You can throw everything here, and you won't be able, and you'll see if there is sometimes you need to put here. But if whatever you are working on your business, if that's a passive income, you won't fill up page 1. No, you'll fill up a schedule K. If that's a real estate, you'll fill up schedule K, not page 1. But you fill up form 8825 with your rental property informations, and that will roll to here for the incomes. So if you have a portfolio income, you will fill up this section here, not page 1, but this section here for interest or dividend, or if you have investment and that require a schedule D, you'll fill up schedule D, 1055 schedule D, and those information will flow to here. You won't fill up page 1 for passive activity or passive activities. You fill up page 1 for active activities, trade or business. And then if you are filling up schedule 1 for your passive activity, whether it's portfolio income, rental properties, or real estate, or rental real estates, you fill up schedule K, and you put your deductions here depending on what it is. But a lot of time, like your supplies, your mails and things like that will go under other deductions, and you will use W, is it W? I believe so. And you usually attach, and you will attach a form where you list the different type of deduction that you put under other. And contribution here is more like charity contribution, charitable contribution, so donations. So but a lot of deductions related to your passive activities that you can deduct will follow here, and some of them that you cannot deduct will fall under 18. And here, non-deductible expenses. So if you have like for example a startup cost for a passive activity, you cannot deduct it, so you'll put it under non-deductible expense. That'll go down there. If you have a rental, if you have a property you held for investment, you cannot deduct your utilities that you are paying, that the rental you wanted to rent out, but you have now rented a year. The year you are maintaining it, you won't be able to deduct those maintenance fee. If you are making changes to the structure, that will increase the value of it. You'll keep those expenses separate because that will go with the basis of the property and be depreciated. But for utilities or maintenance, cleaning fee, they are not deductible until you rent it out. When you rent it out, those maintenance expenses, maintenance costs in the year you rent it out, that's the one you can deduct. But the year you didn't rent it out, those expenses are not deductible. They'll go under 18C. And that's pretty much how you fill up Schedule K for your 1065. If you are in a trade, you have an active business, or you have a passive business, passive income business or passive income. And here, limited partner, a lot of time you'll fill up this section here, but you can read the instruction between individual active and individual passive. But for L.L.C, a lot of time you'll fall under either one of those two categories. It can be very confusing, and keep in mind that your Schedule K balance will flow to this line here, page 5, row 1 or line 1. And that will tell you what you can summarize. That's line 1 to 2 for the income, minus 12 to 13 D and 16P for the expenses. And Schedule L is pretty much the balance sheets, but you may not be required to fill it up. And Schedule M1 or M2 is more about your income throughout the your income, yeah, throughout the year. yeah, throughout the year, when the balance sheet is just a state, financial state at the beginning of the year and at the end of the year. But you may not be required to fill up this, but I like to, you know, to have a spreadsheet layout like this where I fill up those information for my business myself, for my own record, making it easy for me to find information that I need to fill up my spreadsheet, to fill up my return, my tax return. So that's pretty much it. Let's go back to the return and see if there is something important here that we can learn from. So rental activities. So they have so generally if the gross income from an activity consists of the amount paid principally for the use of the rental property, tangible property held by the partnership, the activity is a rental activity. Okay, so we are not going to read through that. Let's continue to see if there is something important here that we need to point out. Portfolio income. Portfolio income includes all gross income other than income derived in the ordinary course of a trade or business that is attributable to interest, dividends, royalties, income from a real estate investment trust, a regulated investment company, a real estate mortgage investment conduct, a common trust fund, a controlled foreign corporation, a qualified electing fund, or a cooperative. Income from the disposition of a property that produce income of a type defined as portfolio income, and income from the disposition of property held for investment. So pretty much you can see here, if you have a business that is generating income from interest, dividend, royalties, that's a portfolio income. So if you have a book, you write books, you sell, you have royalties, that's a portfolio income. So you have to think if you want to add that under your trade business. So if you have a business and you are writing books about things, process of doing things, and you are included under that business, that's a portfolio income that you need to separate that activity from the other activities when you are filling up your Schedule K and K1, because it's falling under portfolio income. And we saw it on Schedule K. And keep in mind, Schedule K1 is just the same thing as Schedule K. This session here is the same thing. I'm not sure I talk about Schedule K1 in this session, but it's just the same thing as Schedule K. But it's just Schedule K times the percentage of ownership for each partner. So you put the partner information, your business information will go here, and you put the partner's information at the bottom here, and you just select the right LLC. If you, the partners, the owners of the business, are managing it, that's the G. If the partner involved that you are preparing this Schedule K1 is not managing the business, he's the other LLC member. So you fill up this section, you select this one. It's a domestic partner, H, you select that. You put the partnership, the partner's ownership for profit loss capital here, and you may not be required to fill up schedule this section L, but I like to fill it up with beginning capital account number, capital contributed during the year, and the year net loss or income, and the balance here. So that should track the capital account for each partners. And this right section here is just the same thing as Schedule K. If you fill up Schedule K, You just take that amount times the percentage ownership for the partner and fill up the same sessions for K1. But there is something I wanted to show you on K. That's the royalty. So here, session 7 here, line 7, royalty, they have a session for it. So if you have, your business is about writing books, for example, or whatever that is, and you earn royalties, you don't fill up page 1, you'll fill up schedule K. That's a passive income, a portfolio income, so it'll go under royalty here. And if we go at the bottom of our instructions, I can just type it here, 55. You can look for the business code for portfolio income. Let's see if you'll be able to find it. Portfolio income. It can be hard to find things in this session. It'll be an investment, so I'm not seeing it right away, but you have to be looking. Investment. I thought that'd be a big session for that. But I'm not seeing it right away. Let me see if we go up a little bit here. Doesn't seem to be. Here either. I have a business that I use a business code for. I think the quickest way for me to find it will be to pull that business and see what code we are using, but it should be let me see if I'll be able to find it easily. My business information. So I was right, wandering somewhere here. That's where we should find it. $52.3 here, huh? Well, let's see. Okay, so is under security, commodity, contract, and other financial investment and related activities. I use that for that business. 52,900 other financial investment activities. That's a good one, including portfolio management and investment advice. Okay, so portfolio income, that's that. And the reason why I select this for that business is because we invest in tax lien, property tax lien. If you know what property tax lien is, or if you don't know, is when the state sell the lien, the property tax lien some part of the year to investors. So we invest in that. So pretty much you paying the property owners property tax in advance to the state, so that the state can use that money for their road, school, and all those fundings. And the owner will pay you back through the state with a fee, an interest. And the state will return you that interest after charging you some fee as well. So that's lien, and you have a lien on the property in case the property owner doesn't pay you within a certain time frame. You can claim the deed on that property. There is more to it. Maybe I might talk about that later, but it's not the point of this tutorial. So that business, I classify that under this category because I didn't really find anything here that is really inviting to me to use. But that's finance and insurance, and that's that for portfolio income. So let's get back to where we were before, when we are talking about portfolio income, because the revenue we generate from our tax lien investments is interest. So I classify that business as portfolio income. So if you invest in stock and you have dividends from that, it will fall under this category as well. Or if you write books, it will be royalties. So you can read through your portfolio income section to see what is classified as portfolio income. So I think they have all those instances here. So gross income derived from the ordinary cost of trade includes, and portfolio income therefore does not include. So pretty much you talk about those things here, but that's that. So they explain what portfolio income is. Let's see if there is. Yeah, they talk about grouping activities here. So I don't know where we saw it earlier, but it will be on the page 1. Was it? I think it was on schedule K. They talk about grouped activities here. So, and they talk about it on schedule K as well, schedule K1 as well. So grouping activities, generally one or more trade or business or rental activities may be treated as a single activity in the activity if the activities make up an appropriate economic unit for measurement of gain or loss under the passive activity rules. Whether activities make up an appropriate economic unit depends on all the relevant facts and circumstances. The factors giving the greatest weight in determining whether activities make up an appropriate economic unit are similarities and differences in types of trade or businesses, the extent of common control, the extent of common ownership, geographical location, and reliance between and among their activities. So, and then they have, let's read this example because I found it very fascinating. The partnership has a significant ownership interest in a bakery and a movie theater in Baltimore and a bakery and a movie theater in Philadelphia. Depending on the relevant facts and circumstances, there may be more than one reasonable method to group or for grouping the partnership activities. For instance, the following groupings may or may not be permissible. A single activity, so that means you can group everything as a single activity. So pretty much what they're talking about here, that partnership has a bakery and a movie theater in Baltimore and a bakery and a movie theater in Philadelphia. So how do you want to group those activities? So you can group them as one activity, or a movie theater activity and a bakery activity. So that means you group movie theater from Baltimore and Philadelphia together and bakery from both states together. Or a Baltimore activity and the Philadelphia activity are for separate activities. So once the partnership chooses a grouping under those rules, it must continue using that grouping in later tax years unless a material change in the facts and circumstances make it clearly inappropriate. You know, that's why I have all my businesses separate. You know, I have even my trade, I have them separate, but my lawyer think that would just be too much form to fill out and things like that, and too many biannual reports to fill out with the state, to just group all the activities in one and group all the real estate in one. I mean, that's a good advice, and he doesn't think you will. I mean, he did agree that you have to track all those activities, expenses, and income separately, but on the form, you group them, you total them together. That's the total income, the total expenses you put. Yes. But according to IRS instructions, you have to attach something to your K and K1 showing the activities, income, and expenses, and all that. So that if a partner doesn't materially participate in one, he or she does not apply the laws against his other, you know, incomes from active activities. So yeah, the IRS thing, you should list them. But yes, you can group them or you can just keep them separate as well. And keeping them separate, in my opinion here, but yeah, that's pretty much whatever you wanted to explain. Keeping them separate is why I have separate L.L.Cs for them, and it's a lot more taxes to fill out. But you know, you just keep everything separate. But it makes so much sense to group them the way my lawyer suggested, all under one L.L.C. And but once again, you will need to, if you group them, you will need to keep them grouped, unless you have really a good reason to change the grouping. So IRS may regroup the partnership activities if the partnership grouping fails to reflect one or more appropriate economic units, and one of the primary purposes of the grouping is to avoid the passive activity limitation. So that's that. So limitation on grouping a certain activity. So the following activity may not be grouped together: a rental activity with a trade or a business activity. So that's good. And my lawyer agree on that as well, that yeah, we can group all our trades together, all our businesses together, and keep our rental activities separate. So that's that here as well. You cannot group your rental activity and your trade or business activities together unless the activities being grouped together make up an appropriate economic unit, and the rental activity is insubstantial relative to the trade or business activity, or vice versa, or each owner of the trade or business activity has the same proportionate ownership interest in the rental activity. If so, the proportion of the rental activity involving the rental of property to be used in the trade business activity can be grouped with the trade or business activity. So there is an exception as well. An activity involving the rental of real property with an activity involving the rental of personal property, except personal property provided in connection with the real property or vice versa. It cannot be grouped either. So they're just listing things that you cannot group together. An activity with another activity in a different type of business, and in which the partnership hold an interest as a limited partner or as a limited entrepreneur. If that other activity engages in holding, producing, or distributing motion, picture, film, and videotapes, farming, leasing, section 1245, property or exploring for or exploiting oil and gas resources and geothermal deposits. So any activity with another activity in a different type of business, in which the partnership hold an interest as a limited partner. But here is that. So that's why if you are unsure your businesses activities are related, it might just be okay to just have different entities for them, or when you group them, just keep them separate by providing attachment to show each one of the activities, income and expenses. So that's that. And some activities conducted through other partnership may not be grouped either. So I think let's go down again to see if you'll find something something interesting to talk about. So reporting, passive activity reporting requirement. So let's see what they are talking about here. So if the partnership carries one or more than one activity, provide an attached statement for each activity conducted through the partnership that identify the type of activity conducted, trade or business, rental real estate, or rental activity other than real estate. And the attachment statement for each activity provide a statement using the same bus number as shown on Schedule K1, detailing the net income, loss, credit, and other items required to be separately stated under Section 702 from each trade or business. So that's pretty much where you are going to be they are just talking about how you should be, creating your attachments for those activities that you put together, and you can read it in that session as well. And it went down, identify the net income and all that. So let's get down again. And that's where here they are talking about the different way of filling up your form. And I talk about that in other videos, so I'm not going to dwell on this much. I just didn't touch the partnership limitations, the difference between active and passive and portfolio income, and I wanted to touch it here. And that's pretty much it. So you'll just read those. You can read through it to see how you'll fill up those forms. And the deduction, you will see what goes in the deduction section on part 1, and what will go under your non-deductible as well. It's quite important. And on Schedule K, let me see here if you have more things to show here. There is something else regarding startup costs. I didn't see it here, but it'll be good to point it out as well. I don't know if I'll be able to find it right away. I didn't touch that information with you, but if you are just starting up, where did I find startup costs? I know they talk about it under deductions, but they didn't elaborate on it. Let me see if I can find it here. not seeing it here, but what about 20? Line 20, talk about it. Okay, so other deductions. Let's talk about this section a little bit here. What this line? I like line 13, and keep in mind that those deductions are on, I believe, Schedule K. Let me go up a little bit and make sure on that we are talking about Schedule K here. No, I think it's still page 1. It's page 1. Let's see, is there something we can say about employee benefit program? I'm not going to go into detail on that. So line 20, other deduction. Let's pull the form and look at it. When I'm working, I'm trying to read IRS instructions. I like to have the form and look. And as you can see here, other deductions here. So the deduction, that's on page 1. If you have a trade, you see, if you have a trade, so that deduction, what goes in it? So enter the total allowable trade or business deduction that aren't deductible elsewhere on page 1 of Form 1065. Attach a statement listing by type and amount each deduction included in this line. Example of other deductions include the following: amortization, and I think you do amortization. I'll talk about that another time, but yeah, you'll include this form for the first time. Like when you introduce you have a new equipment that you need to depreciate in your business, then you'll use that form for the 562 for the first year. So insurance premium, legal and professional fee, those are, your legal fee will be like lawyer, tax, return fee, and all those professional fees. Supplies used and consumed in the business, you see, they will go under line 20 of your business for page 1 if you materially participate in your business. So, and that's a business, not a passive income. And certain business startup costs, that's what I was looking for. So if that's your first year of filing your business tax and you created last year, 2019, the startup costs, you can deduct it or you can capitalize it within like 180 months or something like that. You can, yeah, amortize it or depreciate it for 180 months or something like that, or you can just deduct all of it. So, but if you want to deduct it, it'll go under line 20, and that's that. So I'll just give you an example. I was working on one of my businesses tax yesterday. That's an L.L.C in real estate, and we just created last year, and we have not started in any rental yet, but we have some money in the city that generates interest, and I fill out the tax return for it yesterday, and it has a startup cost or organizational cost. When we file the certificate of organization with the state, we pay $50, so that's an organizational cost. But guess what? Because it's a passive income, because it's in a rental property business, we cannot deduct that organizational cost, because you have a section under 20, line 20 on page 1, but rental property doesn't go on page 1. So for that purpose, and on top of that, we didn't really start the rental property that year. So we have an interest to report on Schedule K, but we are not going to claim that deduction. That's why this form that I'm using, you will see on Schedule K, on this 18C non-deductible expense, I have this $50 here. So if you have a passive income or portfolio income, rental property, your startup costs, organizational costs are not deductible. They'll go under 18C. But if you have a trade and you materially participate in it, and that's your first year, your organizational costs can be deductible. They have a limit. I think it's $250, but I'm not sure. $500, $600. I think it's, I don't know, I don't remember, but they will have more information on that, how much maximum you can deduct. So if you spend less than that, you can deduct everything that first year, or you can deduct up to the maximum that you can deduct, and the rest you'll amortize it for 180 months or something like that. And I thought I come across it earlier on top when we were going through a lot of things to see if they talk about organizational costs. Oh, here is it. So business, startup, and organizational costs. Generally, a partnership can elect to deduct a limited amount of startup or organizational costs paid or incurred. Any cost not deducted must be amortized as explained below.